Imagine you launch a brand new product.
Yeah.
Your team works overtime. You completely crush your sales goals.
Mm-hmm.
You bring in millions in positive cash flow, and your reward for all this.
Yeah, a promotion, right?
Well, no. The accounting department hands the CEO a spreadsheet proving that you actually lost the company money.
Oh, man.
And your entire division needs to be shut down.
It's wild.
Right. So today, we are looking at this ultimate business paradox, like how following the rules of standard accounting perfectly can actually cause a company to actively sabotage its own profits.
It is a massive, just incredibly destructive blind spot for a lot of organizations. They look at this highly detailed spreadsheet, and because the math is perfectly compliant with regulations, they assume the story it is telling them is true.
Right, yeah.
But regulatory accuracy and business truth are two completely entirely different things.
And that is the core mission for today's deep dive. We're pulling from this fascinating chapter on overhead allocations, just to figure out why the numbers we use to report to the government are often like the absolute worst numbers to use when you're actually trying to run a business.
Yeah, the distinction really comes down to compliance versus strategy. And blending the two, well, that's where the danger lies.
Okay, let's unpack this, because honestly, allocating corporate overhead to individual business units, it feels a lot like going to a very expensive dinner with 5 friends.
Oh, I know where this is going.
Right. You only order a side salad.
Yeah.
But the group decides to just split the $500 bill evenly.
Right.
So you end up paying $100 for a few pieces of lettuce.
Yeah.
And your personal financials look disastrous, even though the restaurant as a whole made great money.
Exactly.
That is essentially what corporate headquarters does to its individual product lines, isn't it?
That is a phenomenal way to visualize it. I mean, it really is. And before we look at the damage this practice causes, we kind of need to understand the mechanism behind why companies even fall into this trap in the first place. So corporations are legally required by generally accepted accounting principles, right, what called GAAP. They're required to allocate their overhead expenses to individual profit centers. And they have to do this when they're preparing information for regulators.
Right. The text mentions the IRS and the Securities and Exchange Commission. But, I mean, why do those agencies care how we slice up the HR budget?
Because of how inventory and assets are valued. By law, if you want to value your inventory using methods like LIFO or FIFO for tax purposes, the IRS requires you to fully absorb those overarching corporate overhead costs into the product's price tag.
Oh, I see.
Yeah, you can't just leave $1 million of corporate overhead floating in the ether.
Right.
It has to be anchored to a physical widget so regulators can track the true, fully loaded cost of goods sold.
So the accounting department isn't being malicious here.
No.
They are just fulfilling a strict legal requirement. The problem starts when management takes those exact same compliance spreadsheets, walks into a boardroom, and uses them to make strategic decisions.
Exactly. And the source text explicitly calls this out. It says that people incorrectly presume that a methodology required for regulatory compliance is also appropriate for intelligent management decision-making.
And it says.
The text literally says nothing could be further from the truth.
But hold on. Let me push back on this for a second.
Sure.
If I'm as the CEO, I still have to pay the $1 million lease on headquarters. I have to pay the legal team.
Right.
If I don't force my product lines to cover those costs in their individual margins, aren't I just sort of burying my head in the sand? Like, the money has to come from somewhere, right?
Well, yeah. But covering a cost globally is entirely different from allocating it arbitrarily.
Okay.
The company as a whole must absolutely generate enough cash to cover the headquarters lease. But the moment you take that loose and you artificially assign pieces of it to product A, product B, and product C based on some formula...
You're splitting the dinner bill.
Exactly. You distort the reality of what those specific products are actually contributing. You basically start managing the allocation formula instead of managing the business.
Which perfectly sets up the real-world fallout. The source material outlines 5 specific unintended consequences of making this mistake.
Yeah.
And this is where the everyday reality of a corporate office really just clicks into place for me. The first one being this allocation system absolutely fosters office politics.
Oh, completely. It fundamentally changes the incentives for your managers. If If overhead costs are going to be dumped on a department based on some internal formula, a savvy unit manager isn't going to spend their time trying to sell more product.
Right.
They are going to spend their time in committee meetings manipulating the allocation methodology to push those costs onto other operating units.
Right, like if I can convince corporate set to allocate overhead based on square footage instead of head count.
Yes.
And my department happens to have a smaller physical office.
Suddenly you look great.
Right. Suddenly my profit margins look incredible. I shine. I get my year-end bonus. But the company as a whole hasn't gained a single dollar in actual revenue.
Nothing.
We just shuffled imaginary money around.
It's pure defensive posturing. And if your managers are playing defense against their own accounting department, they certainly aren't innovating.
Yeah.
Which ultimately leads to the second major consequence. The system severely inhibits new product introductions.
Because if you launch something new, it just becomes a target for the allocation crosshairs.
Precisely. When a company analyzes a potential new product, traditional accounting assigns a portion of the existing corporate overhead to it.
Right.
This instantly inflates the estimated cost of this brand new, very fragile product, making its potential profit contribution look severely understated.
Which makes zero logical sense. I mean, the corporate headquarters rent isn't going to increase just because we launch a new line of widgets.
Exactly.
Why would we charge the new widget for the existing rent?
Yeah. You shouldn't. The rule for strategic decision-making should be to only look at incremental costs.
Incremental costs.
Right. If an overhead cost won't actually change as a direct result of launching the product, it has absolutely no business being in the analysis.
Okay, so let's say a manager actually fights through all that political red tape and manages to launch a new product anyway.
Okay.
And let's say it's a massive hit.
Yeah.
This brings us to the third consequence, which honestly blew my mind when I read it.
Yeah, this one is tough.
The accounting system actually punishes success through this mechanism called overabsorption.
This is a classic example of spreadsheets just completely losing touch with physical reality. Under standard allocation rules, overhead charges are assigned to products regardless of the volume you actually sell.
Wait, break that down for me. If a unit manager completely crushes their sales goals, like they sell double what anyone expected, what happens?
The accounting system just keeps churning. It keeps attaching that overhead allocation to every single new product sold.
Oh.
But think about the physical reality. The actual real-world corporate overhead for the year, the rent, the salaries, the insurance, that was already fully paid for by the initial baseline of sales.
So the system is generating entirely fictitious charges.
Yes.
It just continues to pile on overhead costs that do not exist in the real world anymore, driving down the on-paper profits of that wildly successful business unit.
Exactly.
So the manager knocks it out of the park, brings in mountains of cash, and the spreadsheet says, well, your margins are terrible because you incurred so much overhead.
They are literally penalized for succeeding.
But wait, wouldn't the accountants catch this? Like, surely at the end of the year, they reconcile the books, realize they overcharged the department, and fix the discrepancy, right?
Well, they do. They correct the excess overhead when the books are officially closed.
Oh.
But the business distortion has already occurred.
Oh.
Yeah. Management spent 12 months making critical decisions, like denying resources or withholding bonuses or altering marketing strategies, all based on bad data.
Because they were looking at the compliance lens instead of the cash flow lens.
Right.
And since we were talking about the realities of volume, that connects directly to the fourth consequence, Larry. This methodology strongly inhibits marketplace aggressiveness.
Traditional accounting ignores the compounding benefits of scale.
Mm-hmm.
Incremental business is usually much more profitable than the spreadsheet reveals. Like if you land a massive customer order, that volume allows for longer, more efficient production runs.
Right. You don't have to stop and start the machines as often.
Exactly. And you can negotiate steep volume discounts on your raw materials.
But the standard allocation system assigns those rigid, heavy overhead charges to every single unit, regardless of volume.
Exactly. So if a salesperson wants to offer a major customer a price break just to secure a massive, factory-filling order,
the spreadsheet will tell management they can't afford to do it.
right. The potential profitability of that aggressiveness is completely masked by the fixed overhead charge.
The system says no. Even though common sense says running the machines all night for one huge guaranteed order is incredibly efficient and profitable.
Yeah.
And when things look bad on paper, human nature is to just start cutting.
Huh?
Which leads to the fifth and perhaps most dangerous boardroom decision of all.
The illusion of saving money.
Yes. The illusion of saving money by eliminating so-called marginal products.
The chopping block. Managers look at a product that appears to be losing money after all these heavy overhead allocations, and they assume that cutting the product will save the company all the variable labor costs and all the overhead assigned to it.
Right.
What they fail to understand is the sheer stickiness of fixed costs.
Stickiness is the perfect word for it.
Yeah.
Because the spreadsheet makes it look like if you eliminate the product, the costs just evaporate.
Poof.
But building sizes don't shrink.
Mm-hmm.
You don't get to chop off the third floor of your headquarters just because you stopped making product line C. The HR department doesn't just disappear.
And labor costs are notoriously more fixed than people realize. They don't shrink appreciably when volume declines.
Right.
You have union contracts, severance packages, the loss of institutional knowledge, and then there's the massive future costs of rehiring and retraining when volume eventually returns.
Right, it's huge.
So to assume all costs will magically decline just because a product is eliminated is simplistic and usually completely untrue.
The source material is actually remarkably rigid on this point. It outlines 3 very specific rules, stating you should never eliminate a product from your mix unless one of these 3 things is true.
And we really need to look at the causality behind each of these rules. So rule number 1, you only eliminate a product if it has a negative contribution margin and there is no operational opportunity to correct it.
Meaning, it actually costs you more in direct, out-of-pocket, cash-like, just raw materials and direct labor to physically make the widget than you can sell it for.
Right.
If you were trading $1 for 90 cents on the factory floor before overhead is even discussed, yeah, you have to stop doing it.
Exactly. Now, rule number 2 is about brand equity. You eliminate a product if it is a quality disaster that is impairing the marketplace perception of your entire business.
Okay.
Even if it makes a little money, if it ruins the reputation of your highly profitable flagship products, the hidden cost is just too high.
That makes perfect sense. What about the third rule?
Rule number 3 is purely about opportunity cost. You eliminate a product if the company is operating near full capacity and desperately needs the space, the people, and the machine time for a more profitable offering.
So you only kill a profitable product if it's physically blocking you from making an even more profitable one.
Exactly.
Because you've run out of warehouse space or assembly lines.
Precisely. If none of those 3 conditions exist, like if the product has a positive contribution margin, it works well, and you have plenty of factory capacity, you keep it. Eliminating it just means losing that positive cash flow.
Okay, to really prove how these accounting illusions can almost kill a perfectly good business unit, I want to dive into the specific case study provided in the text.
Yes, the Middlesex case.
Yeah, this grounds all this theory in reality. It adds the story of the Middlesex Products Company.
This case study is the perfect synthesis of all the dangers we've been discussing.
So we won't get bogged down in the tedious arithmetic, but here is the baseline health of the company.
Okay.
Middlesex Products has 3 profit centers, A, B, and C. They are doing great. After paying for all the direct costs of manufacturing, they generate $1.5 million in gross profit.
Very healthy margin.
Right. Their overarching corporate overhead, so the executives, the building, the insurance, that is $1 million. So they have a healthy total corporate profit of $500,000.
They are solidly in the black.
But let's zoom in on the victim of our story here, Product C. If we look at Product C in isolation, just the cash it brings in minus the raw materials and direct labor it costs to make it, Product C is generating $200,000 in raw positive cash flow.
Okay, keep that positive $200,000 figure front and center.
200 grand. Got it.
Now, watch what happens when the accounting department forces Product C to absorb a slice of that $1 million corporate overhead just to comply with GAAP regulations.
Right?
We get to see the statistical coin flip in action.
The math of deception. Let's say accounting decides the fairest way to allocate overhead is based on revenue. Product C brings in a good chunk of the revenue, so it gets hit with $223,000 of the overhead bill.
But Product C only made $200,000 in raw cash flow.
Oh.
So instantly, the official compliance spreadsheet says Product C is losing $23,000.
Wow. Corporate management looks at that and starts sharpening the axe. But let's try a different, perfectly legal allocation method.
Okay.
What if accounting allocates based on the sheer number of units sold?
Right. Volume.
Yeah. Product C is a high-volume item. It accounts for 1/3 of all units moving out the door. So it gets hit with 1/3 of the overhead, $334,000.
That is brutal. Now, Product C's 200,000 positive cash flow is buried under a massive $334,000 charge.
Oh, man.
The spreadsheet shows a devastating loss of $134,000.
Wow.
The text literally says its days are numbered at that point. Management would be rushing to shut down the assembly line.
But wait, let the accountants flip the coin one more time. What if they decide to base the allocation on direct labor hours instead?
Okay.
Product C is highly automated, so it doesn't actually use much direct labor. Under that perfectly legal formula, it is only charged $150,000 in overhead.
Which changes the entire dynamic.
Right.
Its $200,000 gross profit easily covers the $150,000 charge, and the spreadsheet suddenly shows Product C making a healthy $50,000 profit.
This is the most terrifying part of the whole chapter. All three of these methods, revenue, units sold, and direct labor, are completely acceptable under GAAP requirements.
All of them.
The fate of Product C, the livelihoods of the people who work on that line, whether it gets massive marketing investment or gets thrown in the trash, it all depends entirely on an arbitrary statistical choice made in the back office.
That is the ultimate danger of managing by allocation. The strategic reality is that Product C is contributing a positive $200,000 to the overall corporate ecosystem.
Period.
It doesn't matter how you slice the overhead pie. The pie remains the exact same size. If you cut Product C because the spreadsheet said so, you do not save that overhead.
Right, the building doesn't shrink.
Exactly. The $1 million headquarters lease still exists. You've just eliminated the $200,000 that was helping pay for it.
You literally burn a $200,000 hole in your own pocket because you optimized for the wrong metric.
Which forces a very uncomfortable conversation in the boardroom. Because if you can't blame Product C for the fact that corporate overhead is eating up the profits, how should management actually respond to excessive overhead?
You have to point the finger somewhere. It's not at the factory floor, then where?
You point it at the mirror. You hold the corporate departments themselves accountable.
Ooh.
The strategic solution isn't asking the profit centers to figure out a mathematical way to absorb massive corporate costs. It is physically reducing the budgets of the corporate departments. And the text provides some really fascinating historical context for this.
Right. It talks about the intense economic pressure during the recession from 2007 to 2009.
Yeah. Prior to that, companies would often just raise selling prices to cover up their corporate inefficiencies.
Just pass it to the customer.
Exactly. The market was hot, so consumers absorbed the bloat. But during the recession, that was no longer an option. Companies were forced to look at their actual cash flow, and they realized they had to hold corporate managers accountable.
Millions of middle and higher level managers became expendable and lost their jobs, not because the underlying products were failing, but because companies simply couldn't afford the luxury of excessive corporate staff anymore. Accountability finally had to sit where the costs were actually being controlled.
Now, if we take this same cash flow logic and apply it to future growth, we run into the final major hurdle discussed in the source, and that is how a company evaluates new business.
Oh, this is the Product D dilemma.
Yes, beautifully illustrated by the Product D dilemma.
This scenario is so common. Middlesex Products wants to grow, so they are considering launching a new offering, Product D.
Okay.
They forecast 100,000 units in annual sales. And after subtracting the direct costs of making it, the incremental gross profit is $1 per unit. So launching Product D will generate a clean $100,000 in total gross profit.
And applying our earlier rule about opportunity cost, the company confirms they have plenty of factory capacity.
Right.
Launching Product D won't require building new facilities or straining existing resources, so the overhead remains fixed.
But here is the psychological trap for management. Product D has a gross profit margin of 25%. The overall company average for Middlesex right now is 33%.
Oh, you see that all the time. Management is fiercely protective of their margins.
Right.
If the company measures its success by gross profit percentage, the proposal for Product D gets rejected immediately.
Because it hurts the average.
Exactly. Adding a 25% margin product will mathematically drag down the overall corporate average.
And it gets even worse if they fall back into that unit allocation trap we just dissected.
Oh, yeah.
If they spread that $1 million corporate overhead across the new, higher total number of units being produced, Product D gets hit with a $250,000 overhead charge.
And since Product D only generates $100,000 in gross profit, the compliance spreadsheet projects a disastrous loss of $150,000.
Wow.
It gets rejected twice over.
But let's strip away the percentages and the arbitrary allocations.
Yeah.
Like what happens to the actual money in the bank?
If you look strictly at cash flow, the reality is undeniable. Product D brings in $100,000 in incremental positive cash. Because we have sufficient capacity, our corporate overhead does not increase by a single penny.
All right, no new buildings.
Right, it stays exactly at $1 million. Therefore, that new $100,000 flows entirely, completely untouched, to the bottom line.
Oh, wow.
Overall, corporate profit goes from $500,000 to $600,000.
This is the mic drop moment of the entire deep dive. By adding this quote-unquote low-margin product that the spreadsheets absolutely hated, the company increases its total revenue by less than 10%. But that results in a massive 20% increase in bottom-line profit.
It fundamentally transforms the financial health of the business.
But you only capture that win if you have the discipline to ignore the percentages and ignore the gap allocations when you are in the boardroom. As the saying goes, you take dollars to the bank, you do not take percentages to the bank.
Which synthesizes the overarching lesson here perfectly. I mean, no one is suggesting we throw out the accounting rule book.
Right.
GAAP is absolutely required. It provides a necessary standardized language for bankers, security analysts, and government regulators who rely on uniform company reports.
It's the structural blueprint. It has to exist.
It does. But to make dynamic decisions that actually improve the physical performance of the business, managers must use a different lens.
Right.
They must focus on incremental cash flow. Regulatory compliance and strategic cash flow analysis are two entirely different methodologies. They don't have to conflict as long as leadership clearly understands which tool to use for which job.
If you're managing a P&L right now, you've probably lived through this nightmare during budget season.
Oh, absolutely.
For me, the real takeaway from this deep dive is realizing that business isn't just about accepting the math you were handed.
Right.
It is about having the vision to see the physical reality behind the numbers. It's about knowing when a spreadsheet is telling you a story and when it's telling you the truth.
It requires the courage to question the default metrics. When a perfectly calibrated system tells you that a highly successful product is a failure, or that a 20% increase in real profit is a bad idea because it lowers an imaginary average, you have to trust the cash flow.
And that leaves us with a pretty provocative thought to mull over. We've just seen how perfectly legal, universally accepted, quote-unquote, best practice accounting rules can make a thriving business look like a complete failure on paper.
Yeah.
So it makes you wonder, what other universally accepted metrics in our own lives, our careers, or our personal finances are secretly sabotaging our decisions, simply because we are optimizing them for the wrong audience?
That's a great question.
Are we living our day-to-day lives by the IRS's rulebook, or are we paying attention to our actual physical cash flow? Something to think about.